Corporate finance practice problem using OneNote. Preferred stock floating rate. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1732 Preferred Stock Floating Rate tab. Also note, when using OneNote, look at the immersive reader. Our presentations up top will be in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. Going to go through the calculations on down below. We're looking at the preferred stock, and we're thinking about the difference between a straight preferred stock and a floating rate preferred stock, generally from the standpoint of the investor. So we have the straight preferred stock, which is the typical preferred stock that we would think of. Remember, in general, the preferred stock is the type of stock which the dividends would typically be paid to before paying the common stocks. And so that's what the preferred component are, but they're going to be limited to basically the terms of the preferred stock, which are typically in the straight type of term, where you have a set yield that has to be paid each year generally. And if it's not paid, then it can simply accumulate upwards before you can pay basically the dividends to the common stockholders. So the straight preferred stock, we're saying the par value is going to be the 100, the yield is the 15%. And then we have the floating rate preferred stock with a par value of 100 and the yield of 11%. Now the benefit on the floating preferred stock would be, if we're on the investor side of things, we're thinking, well, what happens if the rate goes up in the future? It would be nice if the preferred stock in our investment, the return would go up as well. And that would be the floating type of rate. So it's going to be tied to something that will allow it to basically fluctuate up and down. Many people on their individual side of things might have experience or know people with experience with a floating rate on the borrowing side of things when you're talking about, say, mortgages and the difference between a fixed mortgage rate and an adjustable mortgage rate. On that side of things, the flexibility of the interest rate is often considered a bad thing, because if the interest rate goes up and you're the borrower, then you end up paying more interest. If, however, you're investing and you're receiving the interest, then it's kind of nice if your investments will fluctuate with the interest rates, because then you don't have to basically do that adjustment yourself. It should basically, your investments should caliber to the current market conditions. Now, note that since you're investing in something that could vary in that way, that could lower the risk of the investment and therefore the return in general being lower, although it should fluctuate with the market as the market fluctuates. So since the issuance of the securities, interest rates have gone up by 2%. So we imagine they go up by 2%. Well, what would that do to the price then? So the price of the floating stocks, we would actually think would be basically the same, still 100, due to the adjusting rate. So in other words, if the rate adjusts for the floating preferred stock, then the par value should remain the same, given the fact that the rate is adjusting in accordance with market conditions. If we look at the price of the straight stock, then it's still going to be at that 15% yield, but now we have a difference in the market for the 2% difference. So then how can we take that into consideration with the par value, which is spelled wrong? Par value is going to be the 100. It's spelled wrong up top there as well. So that's okay. We know what it means. We know what it means. So 100, and then the yield is going to be the 15%. Let's pull out the trusty calculator here. Trusty calculator. We got the 100 times the 0.15. That's going to be our 15, the annual return. And then the yield is the 15%, and the increase is 2%. So that gives us the 17%. So we're going to take, so if we take then the 15 and we divide it by the 0.17, we get about 88.24. So we can see the fluctuation in the price for the straight item here due to the fact that the interest rate is not changing versus the price for the floating preferred stock, which we could imagine remaining the same due to the fact that the interest rate, the return, will fluctuate along with the market.